Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, every time we start getting really convoluted and troubled times, I start getting requests for Dr. Jim Willie. He is the publisher of the Hat Trick Letter. You can find it on goldenjackass.com. Dr. Willie, thank you so much for joining us today on USAWatchdog.com.
Oh, my pleasure to be back. Always fun.
Well, listen, we have all this fiasco in Washington. The government shut down. It's your fault. It's your fault. Democrats, Republicans, the debt ceiling, we got to raise it with $17 trillion and counting with the debt. They're talking about calamity. Meanwhile, in the background, the Treasury and the Federal Reserve and the Treasury bill market is all still running quietly in the background. And according to one of your latest articles, it's in trouble. And they're having trouble levitating it and propping it up. Could you explain the problems with the Treasury bond market?
Oh, gosh, that would take an hour, but there's so much abuse going on in the Treasury bonds. I watch what's happening with the debt limit and the shutdown of the government, and honestly, I'm not glued to the set. I haven't had my television on in 3 days. So I don't care what they're doing. They're just gyrating around like a dead man kicking his shins up and down. It's interesting that the Obamacare was used as a leverage for shutting down the funding. But there's a whole lot more going on behind the scenes. Maybe it's some real big objections to the defense budget that are not coming out. Honestly, I don't really care about their stupidity of left side, right side, Republican, I call them, and Democrat, I call them. And now you've got potential split with the Republicans and the Tea Party. Well, you know, I used to like and respect the Tea Party back about 3 years ago until I realized they haven't done a damn thing. And they voted for extension of the securities and Patriot Act. What the hell did the Tea Party people do? Now, they sold out. So if they're talking about a split in the Republican Party, I don't give a damn. What's going on with the Treasury bonds right now is systems are breaking. I mentioned a year ago when the London Whale came out, that was May and June of last year, that the Treasury bonds are like a Tower of Babel, whatever you want. I don't know how. Tower of Babel. And the interest rate derivatives are like the flying buttresses that hold it steady at the 80th and 100th floor, this big tower. Well, what kills off and wrecks the interest rate swap is movement in bond yields. Not just, oh, they're going up and they're damaging the bond. No, movement, up or down, in quick movements, in quick sudden spurts.
And that's because they're so highly leveraged.
Yes.
Just little movements mess up the derivatives and the interest rate derivatives where people can lose money on a small move because they're so highly leveraged.
Yeah, except it's not with people. It's with the big banks. People, you know, your friend next door who's a financial analyst type, he's not doing this. This is J.P. Morgan. It's Morgan Stanley. Morgan Stanley is a designated harlot that does these. For instance, back in the second half of 2010, Morgan Stanley put on $8.5 trillion worth of these interest rate swap derivatives. And that's what caused the movement from about 3.25 down to 1.9 on the 10-year yield. And the clowns, you know, I call them talking toots. You can change the vowel in there. You know, you get a pretty good idea. But others have called them the prostitutes. They talk about a big flight to safety. There was none. There was no end demand that took the Treasury bond yield from 3.2% to 1.9%. 2 years ago. There was no demand. It was interest rate derivatives. And my belief is that with the big movement, I've been saying this now for a couple months, with the big movement from 1.65 to 2.95, 130 basis points in 4 months' time, up to the beginning of September, they broke the interest rate swaps. They broke them. they're not functioning anymore. And you can't say, well, you know, they're going to have to redeem them, or they're going to have to close. No, they're not. They don't get closed out. They just accelerate in their losses. And they're not going to take them off, because if they did, you'd suddenly see 4% on the 10-year. They're not going to take these off. They're getting wrecked by foreign selling of Treasury bonds, and they're getting wrecked by internals within the United States, the bond carry trade.
I gotta interrupt you here. Is this why the president had all these financial heads at the White House? Because nobody ever really talked about that. They said, well, it's because of the budget battle and the debt ceiling. They need to talk to all the financial heads because of the budget battle and the debt ceiling? I mean, what do you suppose that meeting was for with the White House, just recently? Why did all the financial heads of the big banks and all the financial institutions, why were they all summoned to the White House? What's your take on that?
The Treasury bond bubble broke.
And that's why all the heads, the right. Financial heads were called. That's the real reason. Forget the debt ceiling.
I'm being brief here. The interest rate bond bubble broke. Its interest rate swap derivative support machinery broke. Foreigners are dumping treasuries. Look at the tick report. June set a record, net minus $45 billion. Indirect exchange from giant asset purchases like Rosneft, the Russian energy firm. All these different things. A huge rebellion going on with big treasury bond holders saying, you've got unilateral decisions on monetary policy taking place by the Fed, and they're really just helping out the bankers. And meanwhile, our prices in Brazil, our prices in India, our prices in Russia and China, our prices of everything are going up, especially food. Well, we're going to get out of this dollar. We're going to start selling more bonds. We're diversifying out. We're going to buy more gold. And I think the meeting was an emergency meeting because they cannot successfully defend the dollar anymore, nor fend off the big treasury bond sales. And they broke their interest rate swap machinery while the treasury bond bubble was pricked. There's an old adage that says once an asset bubble is pricked, it cannot be held together due to exiting momentum. And the other corollary to that is you need an accelerating amount of cash funds going in to support an asset bubble. We're getting the opposite now. We're getting drainage. So what is supporting this asset bubble? The treasuries. It's the Fed. I think they've got gigantic, not 80 billion a month. I think they've got 200 to 300 billion a month or more supporting interest rate derivative losses.
You're not the only one that said that it's not 85 billion a month. I talked to Fabian Calvo, and he sits across the table. He handles a real estate guy handles $100 million in real estate transactions, and he says it's not 85. I don't know exactly what the number is, but it's not 85 billion a month. It's much higher. Much higher.
It's multiple. It's multiples, and you really have to think, well, why? Is it to cover U.S. government debt? No. It's to cover interest rate derivatives. They're imploding. They're breaking. The big buttress at the 80th floor and 100th floor on this giant U.S. government debt tower, the Treasury bond tower, the buttresses are broken, and they're using, I believe, flash trading as a device to turn the market, because notice that some big things happened on September 5th and 6th when we got right within a hair of 3.0 on the 10-year. 3.0%. I think on the other side of 3.0%, Greg, were a lot of sell stops, a lot of Treasury bond futures sell stops, a lot of TNX option sell stops, a lot of leverage things tied to Treasuries. So they said, wait a minute, we need to come together. So what were they talking about at this meeting? Maybe they were talking about a new flash trade program.
And the flash trade is levitating the stock market and the bond market. That now it's down to these high speed, tens of thousands of trades a second for bonds or stocks or whatever it is, and tens of thousands of trades to push the market around. Is that right?
Yes, and we got a good education on it in the last 2 years with we call it flash trading. It's high frequency trading. It's called algorithm trading. It's called computer driven trading. But yeah, I mean, I like to explain to people who aren't very sophisticated. Imagine every second or two, or every half second, or quarter second. But you're more correct. It's milliseconds.
Yeah,
It's thousands,
tens of thousands of trades a second.
Now, what
Some
they
people
do.
say it's millions.
It could be, but I just say that they're a huge number per second.
Yes.
In the hundreds of thousands or millions per
Tens of
second.
thousands is I think a good number. Tens of thousands a second.
But
Sure.
what they're doing there, Greg, and let's focus on stocks and then transfer it to bonds. What they're doing is they're saying, well, we got 7 big banks, and we're going to have you. Bank number 1, move it up a penny. Bank number 2, another penny. Bank number 3, 2 pennies. Bank number 4, another penny. And then we'll rotate it and do it again, and then do it again, and then do it again. And now when we're up 20 cents, which is a mere quarter of a dollar, almost, we'll let the market push it back down. And when the market pushes back down, we'll do it all over again. So we're levitating the price, supporting the price. It can't go down because they're bidding it up. And what bids it down? The market, the legitimate sellers. They say, well, I got a quarter more point there on IBM. I think I'll take it. So they take it, they sell, and push it down a quarter point with other people. And then come the flash traders again. And before you know it, they got another 180,000 shares traded in 2 seconds, and it pushed up a quarter point again. All right, now with the interest rate swap machinery broken, which I anticipated back in August from the big move over 130 basis points in treasuries, I said, wow, be on the lookout for another London whale sighting, because that's what it was back in May last year. Now remember the lie. They cannot talk about a broken treasury bond bubble, because if they do, they get panic selling all across the world. So what they do is they lie about it. They don't really tell us what's going on. And, you know, I just find it utterly amazing that the stories are swallowed whole. Back a year ago, in May, we were told the London whale losses were 1.9 billion, and they were a result of Southern European sovereign bond derivatives. Well, it's a bunch of bullshit.
Well,
take a look at the 90 days before that loss was declared, and you see everyone, Italy, Spain, Greece, even Greece. Greece had the biggest gain, not an interest rate, in bond value, because they were all relaxing in their bond yields. So I did my work, and Rob Kirby and I put our heads together, and Rob said, you know, Jim, take a quick look at that bond. Look at the 10-year bond. It went from 1.7 to 2.1 suddenly. You know, made a good 30, 40 basis point move. Maybe even a little bit more, 60 basis point move. He said, that's the only thing in the leveraged world that went bad. So it looks like J.P. Morgan suffered interest rate swap derivative losses. And they lied about it to blame Europe. And maybe people would say, well, wow, if J.P. Morgan lost money in Europe on sovereign bonds, we should sell the euro and buy the dollar. I mean, this is the kind of bull that's going on to redirect legitimate investors and to deceive them. So I believe what's happening is that the interest rate swap machinery is broken precisely at a time when the G20 nations, the BRICS nations, Brazil, Russia, India, China, and South Africa, they're selling treasury bond. They're diversifying out of treasury bond. They're trying to set up new systems for gold trade settlement. They're trying to take and salvage their giant reserves in sovereign bonds in toxic paper.
They're trying to vent them into the market to get rid of them. They're not going to sell them all at once, unless they have to. Then it'll crash the market. But they're just trying to get their money out little as they can. Right?
I agree, yes. And what it's going to do is cause a big problem for the Fed, which I believe was the basis of the meeting with the White House. I mean, I bet you, dollars to donuts, I bet you J.P. Morgan led that discussion. The president called the meeting, but who's running this meeting? Not. You think Obama or Jacob Lew ran that meeting? No, I think it was J.P. Morgan. Now, I've got a forecast, a new forecast. I made it just a few weeks ago. And, just added to my coming string of another quick forecast. I don't want to get arrogant, but I believe the Fed is not going to taper. They're going to double their QE bond purchase volume. They're going to double it. And why? Because foreigners are selling Treasury bonds. And there's some just extreme irony going on here, Greg. You've got the Russians, Chinese, the Turks, the Indians, the Brazilians, the Iranians. They're all selling Treasury bonds because they see what's going on. They don't like hyper-monetary inflation behind their investment. They don't like debasement of the currency where they hold their reserves. So what they're doing is they're gonna sell, and the Fed must lap it up. If they don't lap it up, we're going to see another repeat of the Treasury bond move. It's not going to go to 3.1%. It's going to go to 4% if they're not careful. Now, I've got a forecast that we're going to go past the 3.0 and move toward 3.5 and higher. But they're going to continue to do everything they can to prevent that. And I believe they're really in a desperate position because foreigners are selling when the Fed is talking about tapering. And the Fed is, I think, redeeming gigantic swaths, $100 billion here or there in interest rate derivative losses. Why did they take AIG and put it under the government roof? To manage the interest rate derivative losses. They don't have a financial statement of value anymore. It's run by the U.S. government.
Question for you: is that in one of your articles you said, "Hey, the Fed, you had a contact of yours at the Dallas Fed, I believe it is, and an insider who said, hey, they were in a near panic. They were selling bonds, and they were raising liquidity. Why were they doing that?"
I believe because of the tidal wave of foreign Treasury bond sales.
So they had to raise cash any way they could to pay those people off so they wouldn't default. So they wouldn't say, yeah, we can't pay you.
Right. They must prevent the interest rates from going up on the Treasury long-term bond yields. If they suddenly go to 3.5% on the 10-year, the U.S. is going to cave in. Not only that, but the U.S. government is going to see their borrowing costs go up $100 billion at a shot. This is not fixable. There's another side to this.
Wait. If it's not fixable, then we're headed for a crash.
We've been headed for a crash for 4 years. They're doing a remarkable job. I give them a lot of credit for preventing it from happening already. Now, why were these big banks short on cash? Why are they having liquidity problems that the Dallas, by the way, it's not my source. This is a friend of mine who's a very smart fellow in Toronto. And he said, Jim, I picked this up from a guy I know who has a friend who works in the regulatory department at the Dallas Fed. So 3 points of separation gave me this story. And I immediately thought, this looks like flash trading. Flash trading has hit bonds. My God, the Fed. Well, let me get to the real problem here. Why are the big banks doing this? Why are they short on capital? Two things. They're losing money on interest rate swap derivatives. Big money, and the Fed is trying to cover it. Second thing, remember all the moronic, arrogant talk in 2010, 11, and 12 from the big banks? We're replenishing our balance sheet. We're making big money on the Treasury bonds. We're borrowing at the 0%. We're buying these 3% and 4% bonds on the 10 and 30 year. That helped bring it down. Now, what Gary North didn't figure out is that these are leveraged.
Hold on a minute. I want
to maturity.
Let me introduce this thought for everybody. I want to get this in here. Gary North, of course, is a guy who worked at Lew Rockwell. He's got a PhD in history, and I thought he was a smart guy until I saw the attempted takedown of your most recent article, and that I did. And I tell you what, it was a real eye opener for me. I'm not as versed in this as you, but I study this. I watch this. Number one, he said that the bankers, they don't have to sell their bonds, I'm paraphrasing, the worse the real world losses get, the less willing the bankers would have to sell. So his theory on your story is that Jim Willie doesn't know what he's talking about. He actually said that. Gary North, Dr. North said, you don't know what you're talking about. He actually said that more than once. The other thing because he says that they can just hold their bonds. They can just hold these losses. You're saying they can't hold those losses. They have to pay people redeeming bonds. They can't just hold the bonds. They have to pay the people who want out. Am I right about that?
Yes, these are leveraged. Okay. And I point to you, Greg. Find me an instance in modern history when Wall Street did not put on leverage.
Yes, they love leverage. 40 to 1, 50 to 1, yes. The mortgage-backed securities, everything. Yes, they love leverage. The other thing is that he says that this flash trading, logarithmic trading, he says, is price discovery. And listen, I sat and watched CNBC 6 months ago and watched bona fide traders. Now, this is on CNBC. They're having a debate with the logarithmic guys and the traders. Hey, listen, there are legitimate shorts and longs. That's legit. That's price discovery. But these guys were saying, no, this is not legit. This is tens of thousands of trades a second. And this is just to move the market, to gain momentum. I think you said it's phony volume. That's a good way to put it. And it's to gain momentum so they can cascade stops down or up or whatever, usually down. But they do this so they can push the market around, and they can, they do this to take money out of the market and to, manipulate the market. That's what the logarithmic trading is. Gary North says this is price discovery. And I'm thinking, what? He says it's legal. Well, yes, it is legal, obviously. But it isn't price discovery. That's legitimate longs and shorts. What do you say to this kind of criticism from Dr. Gary North?
Well, I put together a nice 9-page article and ripped him a new asshole. That's what I say.
Okay. I mean, well, I know. We can link to that. Yeah, it's on your website, so they can take a look at your counterpoint, point by point, on your website, that hat trick letter on the that you work on goldenjackass.com. You have that on goldenjackass.com, correct?
Yes, I do. Here's some of the main points and flaws of his argument.
It's his criticism against you. That's his argument.
I know. And he called it shooting fish in a barrel. And I said, well, you kind of fell in the barrel, and it was really more like a tank. And it doesn't look like you can swim, Gary. And by the way, I was on a swim team when I was a kid. The jackass can swim like a fish. Okay, he doesn't believe the carry trade is at work. He's dismissing the leverage. He says carry to maturity. No, Wall Street likes Treasury bond futures. They see a 3% arbitrage on Treasuries from short-term to long-term, and they'll multiply it by 30 with the Treasury bond futures to make it a 90% gain. And they must manage it. Wall Street loves leverage so much that they made in the 90s a new futures contract called the REMIC, the Real Estate Mortgage Investment Conduit, so they could apply leverage to their mortgage bonds.
Yes.
They came up with the collateralized debt obligation,
yes,
they call leverage squared.
Absolutely factual, yes.
Okay, so obviously the carry trade is not turning out too good. I think they lost a great deal of their profits from the last 2 years. They might have lost all their profits in 2 months that they accumulated in the last 2 years. And now, in order to close out the trades, it doesn't release money into the market to go to stocks. They have to come up with money because these are broken leverage trades. The other big flaw that he had is for capital requirements. Now, I made the point that the big banks are losing money, losing capital from their interest rate swap derivatives. But they're also losing money in their reversed unwinding of the carry trade for Treasury bonds. So 2 big sources of money is attacking their capital. Maybe a second topic at that White House meeting with the financial heads was, we're losing our asses in this carry trade unwind. The irony is that we're joining all the Eastern nations, the G20, the BRICS, the SCO, Shanghai Co-op. We're joining all these Eastern nations in diversifying and selling and redeeming treasury bonds because we in New York and London, we must get out of these leveraged treasury bond carry trade positions.
Otherwise, Jim, they're going to be bankrupt. I mean, even more than they are, aren't they?
Well, that's kind of funny, even more than they are. They're already zombies for the last 3 years with phony accounting, and now they're getting an acceleration. I had a good conversation with The Voice about 3 months ago, and I said, you know, you're talking about a collapse. I'm beginning to think that a reversal in the Treasury bonds could bring about the death blow for these zombie New York banks. And he said, it could be that or 3 other things. And I said, okay, but, you know, we got to focus on things we can see because they're easier to deal with and to integrate with the analysis. He said, Jim, that's a good point. And we've already seen a little bit of a backup in the Treasury bonds. He said, I expect it to go up much higher. And it did. At the time we were talking, it might have been like 2.25%, 2.5%. And I was saying, gee, it's already up to 2.5%, mein Herr. And he said, yes, well, it'll go much higher. It'll definitely threaten 3%. Well, it did a couple months later or 1 month later. Now, what does that mean? It means that these U.S. banks are selling Treasury bonds in leveraged manner, and they're going to impose a nasty factor to the Fed to deal with. J.P. Morgan and the Fed, they're the same.
Well, maybe the White House told the bankers to knock it off, quit selling.
Well, then they're going to go bust. And here's the evidence. They don't have the capital to defend while the foreigners are selling. And they're joining the foreigners in the selling.
They have to.
They have to. They have to get rid of these leveraged carry trade bond positions. These are short the T-bill, long the T-bond. That's the future spread. It's not complicated. It's been going on for 40 years. What happened is their so-called arrogant, easy profit for replenishing their balance sheet just destroyed their balance sheet all over again. Now, these big banks are in danger of imploding, and now I don't think their interest rate swap machinery is working anymore. Why else would the Dallas Fed guy reveal that they're doing this rotating sales at above market prices, which means lowering the bond yield, above market prices among 5 big banks, and then it gets repeated and then repeated. They caused the turnaround at 3.0% on the 10-year yield. And now it's down to 2.65, and everyone's saying, whoa, wow, a disaster averted. No, look at the chart. That's the support mark for the breakout. It just went back to the diving board base, where now it's due to jump up again. Oh, boy. You know,
before we get to the Panama question, how close are we to some sort of calamity, collapse? I mean, how close is it? I've had other guests on here. David Morgan said, you know, we're getting up to the limit. We're getting to the end. What do you say? What say you?
I think we've been at the door's edge, the cliff's edge, for a year. Now, why did they go to QE3 a year ago? Because they were losing their foreign buyers. Why did they get rid of Operation Twist? Well, that was because a lot of foreigners shifted from the 10 and 30-year bonds to the shorter maturity, where they can now feel comfortable with, we can just ride this out. We got a bunch of 6-year and 6-month and 12-month T-bills. We can ride this out. We don't need to sell them. We can ride them to maturity. Then you've got the taper talk and a complete reversal, which was another correct forecast. I said in mid-August, they're going to reverse this taper talk, or they're going to manage a collapse. You know, we're at the death's door edge. What they've got now is 2 lousy alternatives. Do the taper, cut back on the bond purchase program, the QE. I hate QE. QE is made to sound like it's a sophisticated, advanced financial engineering tool. It's hyper monetary inflation that kills capital and wrecks your economy. So they can taper the QE and watch the interest rates rise rapidly, watch their banks implode, watch car loans, home loans all dry up.
Right.
Entire economy implode quickly. Or option B, let's continue with QE, and instead of suffocation from rising rates, we'll have drowning from rising costs. The consequence of doing continued QE is the whole world will hedge against the dollar. And up go energy prices, up go metals prices, up go food prices. And you get more revolutions in Arab nations because that's where they spend 70 to 80% of their income on food. All right, they got two choices: suffocation by rising rates or drowning by rising costs. Which do you like, Greg?
I think what they're going to do is drowning.
Well, I think they're going to drown because it's slower.
Yes, it's slower, and if a rich guy's paying $6 a gallon for a gallon of gas, can I get it? If somebody working at Walmart, $6 is a catastrophe.
Yeah, well, you're going to see the shelves dry up more in Walmart. Walmart's an interesting case study because they've got very efficient inventory management. I remember when I was at Staples, we had an annual meeting done with a guest host, the CFO of Walmart. Wow, CFO. He talked about information technology. He talked about inventory management. He talked about advanced systems, supply chain. These guys are tip-top. And what they've got is a real managed short-term turnaround of their cash. And if they don't have the proper turnaround in their cash, they're going to have empty shelves.
That's right, because they when it's in the store, that's what they got. They don't have a big warehouse. They don't have a big, deep, supply, a cushion. They get it from overseas. It comes in. It goes right to their store. You're saying that in a few days, pow, boom, gone.
Right. If their cash flow diminishes, this is my big point on Walmart. If their cash flow diminishes, the leveraged effect is felt on their just-in-time inventory replenishment. Okay. It's from their cash flow. So you're seeing lower sales in Walmart, multiply it into lower leveraged, lower inventory supply chain activity. Oh my gosh.
Let me just wrap up with this Gary North thing, and I don't want you to toot your horn because I want to toot your horn for you. He said you didn't make any correct calls, and listen, I've been a reader of your work long before I knew you, and I was working at CNN, and I was like, who's this Jim Willie dude? And boy, boom, 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 boom. I mean, I remember you were saying, hey, the government's going to buy all these home loans. I remember that you were talking about how QE was going to go on to infinity. You and Jim Sinclair both about the same time said, oh, once they start it, they're not going to stop it. Well, who would have thought we'd be at, QE4 now, or QE to infinity? And you list all these calls on your site, and you even list a couple of the ones that either haven't come true yet or you missed on. But you have, 18 or 19 calls, which pretty much refute, and they're documented in your newsletters over the years. And it pretty much refutes Dr. North's call that you don't know what you're talking about, that you didn't make any correct calls. I just want to put that out there. The final thing, and you can go on goldenjackass.com and see a list of correct calls and some not so correct calls, but that's a small list of the not correct ones, and future calls. And I want to get to a future call right here, and that is Panama. Been a lot of stuff about Panama. I know you're in Central America, so you're close by. You have contacts all over the globe. And Panama, the rumor is they're getting away from the U.S. dollar, but they're not going to do it boom like that. They're going to be doing it slowly. What's going on with the U.S. dollar in Panama and are other countries going to get away from the dollar? And this again comes up with your theme and your call about increased isolation for the U.S. and the U.S. dollar. Okay.
First of all, I have only one wrong forecast in the last 7 years.
Okay. I said it was a small amount.
One. And another one that looks wrong on the Nordic euro. And the voice said, no, Jim, that's not wrong. It's just slow in turning correct.
Okay.
Let's remember that Gary North's big forecast was for a disaster on the Y2K conversion at the new millennium, that all the economic systems and the banking systems would go kaput. And the jackass's call for Y2K was for melt up in the stock market, an inconsequential event on Y2K from a systemic programming standpoint due to $650 billion and my programming bachelor's degree, which included Fortran and COBOL. Pretty easy fix, Greg.
Yeah, you were right about that. You can take a victory lap there, and he's got egg in his face. But let's get back to Panama.
Okay, Panama.
How about Panama? Are they getting rid of the dollar as the reports are, and how fast does that turn into a problem for the U.S.?
Okay, as preface, just remember that for the last 7 years, we've had a lot of nations go to the yuan swap facility. And that's for doing bilateral trade and settling on a net basis. I always give the example of the Chinese providing finished products to Bolivia for their industrial metals. Okay, so they don't settle in dollars. They settle in yuan with 3 big banks in Bolivia and 5 big banks in China. Well, what is that? Well, that's a weaning process away from the U.S. dollar on the commercial and trade side. The other side of the dollar as reserve currency is on the banking side. A lot of nations, led by Saudi Arabia, they formed this norm, this pattern, this standard. Take your surpluses and put them in Treasury bonds. They did more. They bought up some New York bank stocks too. You know, you got these crazy idiot, thief Saudi princes with their billions of national resource wealth buying Citigroup stock. All right, on the bank side, you've got a few countries that are very tied on the banking and economic side with the dollar. For 25 years, since Noriega was ousted in Panama, you know, Senor Pina, Pina face, pineapple face, because of his acne scars. That's 25 years ago. That's a little more than 25 years ago. They made a deal, a very strange deal, Greg, and I've come to learn this slowly living in Central America. They made an agreement that the Colombians can take their drug money and put it in Panama. That's 1/3 of the money. The Americans can take their CIA narcotics money and put it in Panama's banks. That's the other 1/3. And the third is the Panama Canal with its $8.5 billion in revenue per year and all the gigantic import-export facilities and companies. I mean, you can go by a certain island. I asked a fellow, what are all those office buildings? Oh, that's all the import-export accounting offices. I said, all those buildings? Like 3 or 4 of them? He said, yeah, it's pretty much taken over. So Panama has been on the dollar. And you take a look at their 25 Balboa piece and say, well, gee, you know, I thought that was a quarter. I had a few of them in my hand. 3 were quarters, but one of them is a Balboa, 25 Balboa piece. All right, they've got the Balboa at 1-to-1 valued with the dollar. It's a peg. You've also got the Hong Kong dollar pegged at 7.76 or so to the dollar. You've also got Ecuador that gave up some form of peso. I don't know exactly what it was, but they gave up their currency, and they're on the dollar. And you've got China, which until 1995 was pegged to the dollar. And I used to make jokes back in 2000. My gosh, China is an extension of the U.S. monetary system because they're pegged. Now, they must have a monetary policy that's exactly like the Fed. And they're going to have a hard time getting out of the asset bubble problems that come as a result. And then in July 2005, I remember it like it was yesterday. I was, you know, having a good time at Nags Head, North Carolina Beach, you know, right in your backyard there. I miss the Outer Banks. It was awesome. I used to go for bike rides all day long, a 3-hour bike ride, 30, 40 miles. And, you know, the trick was to make sure you're always, make sure you don't go into the wind out and into the wind back because the wind shifted. These countries are all slowly making their decisions to get off the dollar peg.
And so is Panama.
And so is Panama. I got word from my second best deep source. I don't want to get into much about him, but he has military and security agency experience. He has a lot more experience. He knows people that are managing the narco money for Bush and Clinton. I'm talking trillions. So when he says to me, Jim, we got this global currency reset, and some very weird things are going on in Panama. The bank shutdown that took place for 4 days, that ended last Tuesday, could have very well been involved with the repeg. But its bigger purpose was the global currency reset. Now, you know, I don't want to get into the Iraqi dinar and its launch, you know, to let Iraq come out of the dark ages. But the U.S. government has gotten in the way with this global currency reset. They're basically telling a lot of nations, like 20, 30 nations, we'll cooperate with this global reset and the introduction of some Arab currencies. But you've got to wipe out the $16 trillion in U.S. government debt. And they say, bullshit, I don't think so. So the U.S. is holding this up. Now I've got a different fellow. This is not a deep source. This is a fellow I met in Panama who's a really smart fellow. And we had lunch 2 or 3 times. And by lunch, I mean from 1 o'clock to 4 o'clock. Just sitting around, oh, okay, let me buy another juice there, senora. And we're just talking and talking. He shows me his condo. And I'm thinking, nice view up here, Mike. And, we're having a good old time. He sent me an email this week because I asked him, what are you seeing from boots on the ground in Panama City? Are they really going to ditch the dollar soon? And he said, I don't think they're going to ditch it soon. It's just going to be way too difficult to do. But they're taking steps. And I can tell you that I've done some checking with some guys who know banking activity. The Germans and the Swiss are setting up a stage 3 depository for gold at an old U.S. military Air Force base outside Panama City. It looks like what's going on is some background work to reinforce the new Panama Balboa. And I'm not saying gold-backed Panama Balboa currency. I'm saying gold reinforced with reserves so that when the Balboa floats again, the whole world will not say, hey, we got the Balboa at the Forex, let's beat the hell out of it. No, what they're going to say is let's support it and lift it versus the dollar because it has some gold behind it in reserves with the Panama government. And they don't have a formal central bank. They've got a Banco Nacional de Panama, and don't confuse that with a central bank. There's a Banco Nacional in Costa Rica. It is not the central bank. It's called the National Bank. Like think of the U.S., First National Bank, Second National Bank. Well, they don't have a Second National Bank in Panama. They got Banco Nacional.
So it looks like your theme of increased isolation, this move away from the dollar, is happening around the globe. And with that, I think we are going to wrap up our interview today. Dr. Jim Willie, I really appreciate you coming on and deciphering all the goings-on at the White House. That big story I thought was missed was all the bankers being called to the White House, and they sloughed that off as, well, we're talking about the budget and debt ceiling. And not say you. You say it's the Treasury bonds are in trouble, and they're losing control of the interest rates, and big banks are in deep trouble. Thank you so much, Dr. Jim Willie. You are the publisher of the Hat Trick Letter that can be found on goldenjackass.com. Thank you again for coming on.
My pleasure, Greg. Thanks very much.